Today we are diving into an asset class that's suddenly everywhere, but it still feels mysterious to many. Talking about private credit. What exactly is it? And why is it booming in India right now? And where should it fit in a sophisticated investor's portfolio? To help us unpack this, we have someone who lives and breathes private credit every day. Ankur Jain, private credit fund manager at InCred Alternative Investments. Ankur has over 15 years of investing experience in both private equity and private credit. Formerly, he has worked with KKR, Edelweiss, Alvarez& Marsal, WL Ross and Company, and DB Swern. We'll talk about the deals, the risks, the opportunities, and what he thinks most investors get wrong about private credit. So whether you're an HNI investor, a family office, or just curious about how this side of the market really works, we're happy to host Ankur. Welcome to Ask InCred, Ankur.
Pleasure to be here, Radhika.
So Ankur, I think, in India, everybody today understands equities, mutual funds, the fixed income space, private equity, angel funding. But I think lately we've started to hear a buzz around private credit. So can you, in very simple words, try to explain what private credit is and why is it becoming this hot in India right now?
Oh, absolutely. Radhika, what is the oldest known human profession? It's actually money lending. And as humans evolved, the money lending also evolved into organizations becoming very complex. So not individuals anymore, but large global banks, non-bank financial companies, bond market. They are doing money lending. So the thing about private credit is we also do exactly money lending, but in a fund format. So that's in a very simple terms what private credit is money lending in a fund format. I think the reason for why it has become such a big buzzword is just the, I would say, performance. In last 8 to 10 years since the time private credit has really come into force in India as an asset class, what it has shown or demonstrated is its ability to give or generate returns for its investors, which are predictable, which are meaningfully above the inflation rate and meaningfully beating any other fixed income traditional products on a consistent basis. So 8 to 10 years of track record giving returns which are much higher than what otherwise they would have or investors would have invested into is giving investors confidence. And that is the reason why this buzzword is or it's buzzing as an asset class.
Interesting. So what part of an investor's portfolio do you think this would fall under in terms of an asset allocation?
Fixed income.
Okay.
Clearly, any investor, I think any typical investor should be allocating their money into equities and non-equities. In non-equities, they then can have further bifurcation with respect to a gold, for example, some real estate, and something which is predictable, like, or something which is generating predictable returns or lesser volatile returns like fixed income. Now, till the time private credit was not as mainstream as it is right now, investors were left with no choice but to invest into fixed deposits or government-sponsored schemes like Kisan Vikas Patra or something which is forcing investors to invest into fixed income from the government side. As a result, investors were left with no choice but to invest into such low-yielding investment options. And that is the reason why fixed income side of the portfolio allocation was always a poorer cousin of their equity allocation.
Correct.
Right? But with private credit, I think we are, or as an industry, we now become a true competition to these traditional fixed income products because the kind of returns which this product has generated consistently over a 5, 10, 15 years now is meaningfully higher.
Wow.
And I think that is the reason why the answer to your question is purely fixed income.
Fantastic. There are a lot many more players today in the market today also, right? So like InCred Alternative Investments, how many funds do you have in the private credit space today?
So now we have 4. So now we have 4 funds and scaling pretty rapidly.
So tell me, you mentioned that there are different types of private credit, but in your experience, what are the kind of companies that typically come to you for private credit, or and what do you look for when you're looking for, extending credit to such companies?
Sure. I'll break this into 2 bits. What kind of companies come for a private credit? Um, I'll take a historical route. When private credit in India started, a lot of private credit inquiries from corporates used to come where borrowers would say or promoters would say, I have this security. Can you lend against the securities?
Okay.
Think of it like a loan against share. or I have this piece of land, can I lend against that, which we call as loan against property. LAP was the first stage of evolution of private credit in India. This is how the product got introduced in the market in India, where promoters thought maybe this is what private credit can do. Then came the next phase of evolution where a lot of borrowers who were facing financial difficulties came to private credit market and said, I need money. I think the reason for that is because banks cannot lend to NPA. So that is the reason why second phase of evolution of this market came.
Okay.
Then the burst of, or the evolution actually just multiplied significantly. And companies which are profitable, high growth, requiring working capital support, companies which are startup right now, requiring venture debt, whole host of such requirements started coming in because people realized in the first two stages of evolution of this private credit, this product works. And hence corporates, promoters actually came in for their normal working capital growth requirements also, or venture debt requirements also. I think the next phase of growth, which I am seeing, where I'm seeing a lot of opportunities coming to our market, specifically to us, is promoters or companies shareholder level requirement, where a lot of private equity investors have invested into the past. They need exit. So stake consolidation needs to happen. Or there is a division which is going to happen in family, where one faction of the family wants exit, or other faction of the family wants to consolidate. Shareholder level financing for stake consolidation either within family or giving exit to private equity. So I think multiple use cases where private credit operate. And the last bit which I explained is the kind of opportunities which we are seeing more often than not nowadays.
Wow. Interesting. Yeah. Tell me something, Ankur. Why wouldn't these companies go to the large banks for their, credit requirements? Why would they come to, private credit?
Totally. See, banks and NBFCs will always remain mainstay of credit in any economy. Um, However, why should any typical corporate, for their financing requirement, the the avenues of capital should remain binary, only equity or only debt? When the business environment that they operate in is highly complex, um, their financing channels should also be attuned to the business realities that they're operating in. What if a corporate say, yes, I need debt, but I need debt which the repayment of which aligns to my cash flow generation. I can't pay this monthly EMI or a quarterly schedule which a bank typically provide to me. Or then usage of money that I'm going to borrow should be in that sense flexible. I should have an ability to have an undefined usage and define it as I go. Or lastly, there should be flexibility with respect to the collateral that I'm giving. Most of these things, formal financing channel are not geared up to provide to any corporate. This is where private credit comes into picture, because I fondly call private credit as solution capital. We understand the problem that the corporate has and find a solution and structure a solution in the form of our facility that we give to them. We can provide flexible repayment schedule. We can provide flexible end uses. We can provide, I would say, nuanced collateral packages which we can take as security. So again, most of these things we can tailor made as per the corporate usage.
Interesting. And why would you say there's this sudden, explosion in terms of, the number of players in private credit? What's driving this growth?
Yeah. Yeah, I think I call the current era of private credit in India as the SIP era. Um, just like equity, it took some time for equity culture to really percolate into the masses in the country. And the reason for that was because equity was able to perform and deliver on a consistent decadal basis very, very, very high returns. So investor actually saw what that asset class can perform in their portfolio and help them in their wealth creation journey. Similar is happening on private credit side also. Within private credit, since now this industry has good 7 to 10 years of track record to look back to, um, I think investors are witnessing what this industry has done with respect to the returns that it has generated to the investors. On the other side, the borrowers or the corporates are also seeing what is the kind of flexibility and the solution capital which this capital can provide. Both of these put together has created that kind of, I would say, buzz around this asset class. Investors are coming in, investing into this product. Borrowers are coming in, borrowing this kind of capital.
Lovely. And I think, yeah, offering double digit kind of returns in a fixed income space, Clearly, that's very attractive for most investors. But tell us, where does the risk really lie then in this, right? I mean, obviously, it's a high risk, high return model. So, could you just elaborate on that?
I think the single biggest risk this strategy has, and investors should be cognizant of, is illiquidity. If you are investing your wealth into a product like this, you should be fully cognizant of the fact that their a crore, 5 crore, 10 crore that they're allocating towards the strategy is locked up for a 3-year, 4-year, 5-year period. I'm not saying that they're not going to get anything in the interim. It's a debt instrument at the end of the day. They're going to get regular cash flows out of that fund, but the principal capital will remain locked up for some period of time. So illiquidity is a risk which investors should be cognizant of, and hence this should be part of that side of your portfolio where you can run the illiquidity risk. So I think this is the risk which investors should be cognizant of. From the portfolio creation perspective, I think the credit risk which these kind of funds take, um, I think gets net off because of the portfolio diversification, because of the kind of deals that they do, the kind of structuring that they do. So the default risk or the credit risk really becomes low in a portfolio, but illiquidity risk still remains, and that is what investors should be cognizant of.
Tell us something about how do you, though, underwrite and structure these deals? I think if you can simplistically, because you're talking about protecting the capital, and especially in a country like India, which is, which has a lot of promoter-driven businesses. And, just in another podcast with Mr. Aditya Sood, we were talking about, whether the successive generations want to carry on the legacy of the businesses. So there are a lot of risks involved. So what kind of underwriting practices exist in this?
Yeah. So private credit investing is not desktop investing. Whenever we look at a deal, um, we always think of ourselves as partnering with that promoter or that sponsor who we are lending money to. Um, so as a result, we need to understand that business in as much detail as possible before we take that lending decision out of our fund. What does that entail? It entails spending 2 to 3 months understanding the nuances of the business, both on the commercial side, their own accounting and financing side, taxation, legal, technical side. Once we are convinced that this business is something which we are comfortable of, and we can very confidently and predictably project that business, it's only then we decide, okay, this business is lendable from our fund. That's step number one. Then step number two is, then we decide, okay, now we want to lend to this business, but on what terms? Then we decide on, okay, this is a security that I need for my 50 100 crores that I'm lending this business to. um, this is my commercial, which is my ROI, my tenor, um, and what is the discipline that I want this business to adhere to on a go forward basis. We call them as financial governance and technical governance. Once all of that is established, at least we are sure of, then we enter into negotiation with that company and kind of agree on a deal that, okay, I'm okay to lend 50 to 100 crores on these terms. Once we agree, this is off we go. Then we enter into the legal documentation, which an external lawyer help us to do, codify all the commercial terms that has been there agreed between us and the promoter, and move on to security creation. So a lot of time is spent not only on understanding the business, but on negotiating a transaction, what is the right thing to do when we lend so that we reduce the risk that we are inherently taking that business.
Right. How thorough and interesting that work must surely be. I think, given your experience in private credit for so long, could you give us, one instance or example without naming the company if you don't wish to, where you're very extremely proud of the kind of structure and you know
Hmm,
credit
sure,
support
sure,
extended.
sure. I think, what if we can't provide solution to the corporate? Then we are just like a formal financing channel, right? So there is this company who came to us with a very peculiar problem. They wanted transaction to delivered within 3 weeks.
Oh my god!
And the reason for that is they wanted to hit the capital markets. And before that, something needs to be done for which financing was required.
Wow.
We, when we entered into it, we knew that there is going to be immense time pressure. So we allocated a lot of our energy and a lot of our management bandwidth towards solving for that problem and coming up with a view whether this is lendable or not. Very proud to say within 2.5 weeks, they required money in 3 weeks. Within 2.5 weeks, we were able to deliver a transaction.
Wow.
And it was not a single lender situation. We actually had to create a full syndicate around to deliver the entire capital solution to the company. Yeah, so company availed that financing from us within 2.5 weeks, did what it had to do for the financing that they were availing, and filed for its IPO.
Wow, that's commendable. So, Ankur, I think we've spoken about, some of the, deals that you have fond memories of. But tell me one deal that, initially looked very tempting to you, but maybe there were some red flags that made you walk away from it.
Yeah, so Radhika, rather than mentioning about a deal, let me tell you the behavior patterns or the kind of deals that we don't like doing. And irrespective of if everything stacks up, still sometimes, I mean, reluctantly, we have to walk away. Um, a lot of people actually say logically, you guys should be thinking about cash flows and collateral, right? If you're giving money to a company, you should be bothered about how you're going to get repaid and what is the security that you're going to get. I actually say the third bit, which is character. Cash flow, collateral, no, but character a lot. So we spend a lot of time with respect to corporate governance standards in a company. Any kind of slip ups in the past or what we have observed makes it a red flag for us, irrespective of how strong the collateral is, irrespective of how strong and convinced we are about the cash flow generation of the business. And now to answer your question, I think there has been many instances where despite doing loads of work, any small whiff of corporate governance issue, we have actually walked away from the transaction. And there has been few.
Oh, wow. Very, very high standards, and rightly so. Um, let's talk a little more about information that will be directly very useful for investors. What are the kind of common myths or misunderstandings that think Indian investors think about when it comes to private credit?
Yeah. I get involved into a lot of investor conversations, either to give them an update on what's happening in their investment or convincing them to invest into our funds. One thing which I think I found as a recurring conversation, which I have to a lot of time debunk, is private credit is not comparable to their equity allocation. I think a lot of people get confused. My equity is giving me this much of returns. Why I should be investing into private credit? That's actually not true. You should always be looking at your asset allocation as a prime baseline, after which you have to look at various investment avenues around it. If you're looking at private credit, I am assuming you're looking at fixed income side of allocation. And if that's not the case, please first get the investment allocation, asset allocation right.
Right.
Fixed income, yes, private credit. But if it is fungible, I think you should look at equity first, because age appropriate equity has to be the bulwark of your total asset allocation.
Hmm. Perfect. What differentiates InCred Alternatives private credit fund compared to the others in the market? What would you say is your edge?
Yeah, there are few competitors who are out there. But I think the differentiation that I see us versus our competitor is following things. One is our origination ability. We actually are able to source transactions much ahead of our competitors. So we have origination as an edge. I think second is the pure investing experience that we have within the ecosystem, as well as team that we have built who is managing our private credit funds. Um, Between our NBFC and us, we are very, very, very long duration and large investing experience, which allows us not only to underwrite our transactions right, but also structure our transaction right, reducing risk significantly in our portfolios. So I think these are the two things which I would say is a distinct edge as compared to our competition.
Perfect. I think as a closing question, if I could ask you, what would you wish that investors ask fund managers before putting their money in private credit?
Hmm. So one I have already said, which is I think don't compare it to equity, compare it to credit, or let's say fixed income investment avenues that they have. So I think that is one thing which always investors should keep in mind before evaluating any private credit fund. I think second is track record. Um, for example, InCred's private credit franchise, I think has a long duration, strong track record of performance. Performance is something which investors should always look at. They do that in mutual funds. Similarly, they should do that in private credit also. They should look at past performance of that asset management company, of the fund manager and the team, and decide whether this is a product for them or not.
Perfect. I think thanks so much, Ankur, for taking us through the details of private credit, the discipline that it takes to make it work in India, and the strategy behind it. Thank you so much for doing this for us.
Thank you.